Hi, and welcome to this week's Symax Fintech Weekly Market Insight. So first, as usual, just going through our disclaimer. So trading involves the potential risk of loss of capital and is not suitable for everyone. As I always say, hopefully it is for you. Now, many companies will provide you or offer you leverage. Just be aware because you can lose substantially more than the initial investment. All the views and everything contained in this is just purely for educational purposes, and we are not trying to encourage you to trade or invest. That must be your decision. And before you make that decision, you should carefully consider the risks, your financial situation, level of experience, and risk appetite. And of course, only risk capital you're prepared, but more importantly, you can afford to lose. Any doubts whatsoever, seek independent financial advice before you risk your capital, please. Okay, so, well, when we look at last week, what an eventful week it was, especially the last few days from Wednesday onwards with the Fed raising rates by 25 basis points. And Powell commenting that he expects a couple more to come, possibly before pausing. Obviously, it's going to depend on inflation. Markets paused, the stock market paused and then rallied. The US dollar dropped. Powell emphasised that there was still more work to be done because when you look at their key metric, the PCE, it's still more than double their target 2% inflation rate. Powell also mentioned that the US debt ceiling needs to be raised. And then, of course, Friday, NFP was huge, 517,000 new jobs. No one saw that coming. And unemployment now at 3.4%, which is a 53-year low. Well, you can see the market reactions to all of that data on the charts later. And then, when we look at some of the other data that actually came out, which was overshadowed by all that, of course, we had ISM down slightly at 47.4, with prices paid up at 44.5, although services was up 55.2. Jolts, over 11 million jobs on offer now, incredible in the US. And then, of course, on Thursday, it was Europe's turn, with the Bank of England and ECB both deciding to hike by 50 basis points and indicating that they're not finished yet. Although maybe for the Bank of England, they're pretty close, just given the state of the country. It's got weak growth, persistent inflation. However, do they want to drive the country into recession? Is the big question there. And of course, there's plenty of strikes by workers seeking higher pay. And in the UK, PMI came out up at 48.7. Now, so the ECB raised by 50 basis points as well. And then Lagarde went even further to go back to forward guidance. When last year they said that they wasn't going to provide this anymore and it was all data driven, and stated that they intend, emphasis on intend, to raise by another 50 basis points in March. Obviously, if data drastically changes, that may not happen. And they intend to reduce their reinvestments from maturing assets as well. I think more she was trying to convince the markets with words rather than actions there. She was very sort of emphasizing the fact that, we're going to keep putting rates up, but of course they're still behind the curve anyway when you look at the US and UK for rates. So data-wise, CPI came in year on year. The core was 5.2%, slightly higher. But month on month, it was down 0.8%. Unemployment just ticked up very, very slightly to 6.6% for the zone. But that's still really, really good for them. And then, of course, I've put down what the rates are there. So, we've got the Fed at 4.75, we've got Bank of England at 4% now, and the ECB at 2.5%. So, as I say, the ECB's still got some catching up to do. But when you think, they started from negative rates, negative 0.5, they've bumped from 3% so far. Tech stocks disappointed. When you look at the triple A's, well, the three A's, depends how you want to look at it. I don't talk about credit ratings there. Apple, Amazon, and Alphabet, but they disappointed. And between the three of them, they're valued at almost 5 trillion. Although that fluctuates on every day, the way you see the stock market for sure. But they did sort of cite lower demand there. Oil inventories was a big build last week by 4 million, and that wasn't expected at all. So stocks had a sort of a mixed and volatile week. They rallied, they paused and then rallied after Powell got going with his statement and the press conference afterwards. Gold and oil followed as well, but then Friday, gold and oil really sort of sold off. Oil dropped about $5 on the day, and gold, from almost making a high of 1960, ended up trading as low as 1877. Now, last week, Dixie traded with a 100 handle. That's over 10% off of its high. It was up at 111, sort of September, October last year. And that did manage to reverse a bit of that and make some gains by the end of Friday, obviously because of the data that came out. Okay, so when we move on to this week, there's not much out in the way of data. There's only a little bit, but the highlight will be Powell speaking on Tuesday. And apart from that, Michigan consumer sentiment's out as well. Then in the UK, GDP, they'll probably show that they've just managed to miss a recession so far, but we'll have to wait and see on that. And then there's some house prices and manufacturing data coming up. In Europe, it's retail sales and German CPI. Sweden and Australia got their rate decisions. It's possible, expected that Sweden's going to increase theirs by 50 basis points and Australia probably by 25. With China, we've got CPI coming out now. CPI is expected higher, but PPI lower, which was the same as last time. And as I mentioned before, that means that the producers aren't passing on any cost savings to the consumers yet. And in Japan, we've got PPI coming out as well. So when we go into the macro situation, now we've got most of the central banks are finished now until March. We're going to get the focus back onto the data, especially inflationary data. We do have lower energy prices, of course, and the mild European winter has really helped with inflation. If it's been a harsh winter, God, recession would have been pretty much guaranteed, I think. But it certainly has helped Europe with this sort of milder weather, and it could just keep them out of recession. But in Europe, it's difficult to always guarantee what the weather's going to do next. Certainly in the UK where I am. So food inflation remains, for me, irrationally high. Considering most of the price impactors have actually returned below or around COVID and war levels, pre-COVID, pre-war levels. The only sort of inflationary things I can think of is wages and perhaps, the fact that energy is still higher than it was. But for me, I just keep saying this. I still believe that this is the food giants and the supermarkets overcharging consumers. We all need to eat, so they're just taking advantage of that and just really profiteering from us. Which again, the government and central banks should be looking at that because obviously that is keeping their inflation levels higher than what they're after. So, although the rate increases along with high inflation is reducing that demand, it's still well above what the central banks are looking for, this desired sort of 2% target that they have. And of course, many expect the rates by the end of this year to drop again. I've got to be honest, I don't see that. I expect the central banks will want proof inflation is back under control, and they're going to want to see that for perhaps 3 to 6 months before they really make that decision to even consider changing policy. So it's going to be more of a pause than a cut. But just remember that's just purely my view. And then, with China reopening as well, we've got those lower energy prices, which, again, could help to stave off recession at the moment. But and for me, I'm just concerned that with China reopening, it could sort of boost demand again across all of the commodities and from consumer goods as well. And again, there could be that sort of impact on supply chains for a short period of time. Just by the number of staff that are isolating where they've all got COVID. They only came back from Lunar New Year recently. So all of that travelling, hundreds of millions of Chinese travel either internally or externally. So again, as that really sort of increased cases, they've stopped reporting it to a degree. So it's hard to gauge. But again, I would expect that to probably clear up by the middle of the year. Not COVID to disappear, of course, but just to get back to sort of like the phrase living with COVID. Of course, IMF, now that China's reopened, has increased growth forecast to 2.9%. Although we're still seeing house prices falling, but unemployment remains so hot. I mean, just look at that NFP data. Over 500,000 jobs. But that's, part of all of sort of the shortage of workers seems to be because the 50-plus-year-olds, they're just staying out of the workforce. Why, I don't know. Obviously you've got the baby boomers that have retired, but for a lot of them, is it because they feel that they've got enough money for the moment? Is it that they don't want to go back to those 9 till 5 jobs, so they'd rather work from home or even work for themselves? We'll just have to wait and see. But Europe, so going back to sort of that mild winter, it's leaving stocks high on gases, on gas. And there's a lower consumption, obviously, because of the mild weather. I must admit, though, the evenings do get a bit chilly. But it certainly helped, and it certainly stopped any sort of power cuts so far, which is good for, obviously, households and industry. Will rates drop by the end of the year? Many say yes. I've still got to say I doubt it. The UK now could possibly still enter a recession at some stage this year, although expected it's going to be shallower and shorter than that was forecast by Bank of England towards the end of last year. Saying that, in April the energy cap lifts again, so I would expect to see just a little bump in inflation, sort of about April, May time because of that. Now, wage growth is slowing. But and again, if you're asking for a big rise when inflation is expected to come down, companies are going to be reluctant to give those big rises because they expect, within a year or two, who knows, that inflation will be back under control, 2% or even lower, and there they are giving their staff 4 or 5% increases. But of course. For me, for a decade or more, the workers weren't really rewarded for the efforts that they put in to make all these profits for the companies. The companies were much keener to reward the management and the stockholders, the shareholders, than they were to pass that on. Just a few more points. So on the Bank of Japan, they are going to select a new replacement for Kuroda. So, if you're trading the yen, just be aware of that. Whoever's coming in, are they going to sort of stick with the current policy or look to change that? Interestingly, Russia, their current account surplus more than doubled, and that's despite all the sanctions that were put on them. And obviously, China had the biggest increase in trade with them. So it's possible inflation sort of may remain sticky at these current levels or even pick up a little bit just with China reopening. Or on the other side of it, we could have sort of this weakening demand because of rates being higher and of course the demand dropping because of the cost of everything due to inflation. Uh, I think the picture's not really going to clear until mid-year. And then we will probably get the answer to all of it. But economists could still see a soft or a hard landing as far as I'm concerned.